Hey guys, I hope you're well. I am Joel from Echo Property Group and welcome to our latest mini-series from dirt to duplex. Now guys, for anyone who's been following along, you would know that Bianca and I have developed a number of duplexes for ourselves and also for clients now, and I thought this is a good opportunity to take you guys through what's involved in building a duplex, the highs, the lows, the stresses, and also take you through what to look out for when actually trying to find a duplex compatible site, and also the benefits of a duplex, why build them, some design aspects and all that sort of stuff. So this series is primarily for you guys, and hopefully you can take something out of it and learn a few things and hopefully use it to help you build your own portfolio. Hopefully you get something out of it, guys. Follow along, obviously subscribe if you haven't already. We will be releasing new episodes, and if you want to be notified, just hit the subscribe button and you will get notified. So you can see just behind me here, guys, we've got a construction site. Now this was, I might just flip you guys around. This was originally a house on a corner lot. It was run down, and we saw huge opportunity for obviously developing it and building a duplex. We are currently on the Sunshine Coast, and we are only a few hundred meters from Sunshine Plaza, which is just that way. So we're in a fairly highly densified area. Yeah, obviously I know the planning scheme back to front, and I'm going to go into that in the next episode, but I know the planning scheme back to front, so I know what we need to look for, and hence came across this site, and yeah, we've obviously, we're actually subdividing this and building 2 duplexes, but I'll go into that in a second. So why build a duplex? Now, there's a few reasons for it. Now, our approach to property investing is generally to buy or to develop and hold. Now, there's multiple reasons why we do that. Firstly is leverage. So by doing that, we actually gain a lot of leverage and utilize the property's growth for future investments. Now, when you go and purchase, or you go and, let's say you're just purchasing a standard property, you put 20% deposit down on a, let's just call it a $1 million property. So you've put $200,000 down as a deposit on a $1 million property. Now, if that property goes up by 5% over, say, a 12-month period, that $1 million property is now worth $1,050,000. Now, you've only had to put in 20% down. So you've had to put in $200,000. We'll keep stamp duty and all the purchase costs out of it just for ease, but you've had to put in $200,000, and in a year's time, you've got a return of $50,000. So you have actually only put in a fraction of a deposit, 20% in this case. However, you have received 100%, you've received a return or growth from 100% of the property's value. So the return on your investment is significantly high by leveraging the bank's money, because the bank has kicked in the other 80%, you've only kicked in 20%, and so you've been able to really leverage the entire amount of the property by using the bank's money for 80% of the purchase. Now, fast forward to now, you've got 5 properties all worth $1 million, and they're going up by 5%. So now you've got a $5 million property portfolio going up 5%. You've now made $250,000 of equity in a 12-month period simply by holding property, using the bank's money to pay for majority of it, 80% in this case, and you've only had to kick in 20%. Now guys, some banks are even offering less now, 10% without paying lender's mortgage insurance, and some even less. So, you know, if you've got the equity, you know, we always encourage people to chip in 20%. But in some people's cases, if you're just starting out, you know, you're struggling to save a deposit, there are opportunities there where you can put in less cash and less deposit and still get into the property market and still reap the benefits of a rising market and building equity that way. Because in that instance, that $250,000 of equity you are making in 1 year while you sleep. So you haven't had to get up and go to work to earn that. You've simply let the property market do its thing and you're reaping the rewards. Now, on the flip side, if you're buying and selling, that costs a lot of money. You've got, well, every time we buy, we've got stamp duty, and that's just part of buying property. You've got legal fees, that's part of buying property. But if you can avoid the selling component, you avoid your selling agent's commission, and you also avoid paying tax on the profit. Because if we can hold on to property, we can refinance at the back end, extract the equity tax-free, and use that equity as a deposit for your next purchase. So you can continue building your portfolio and not having to pay a huge amount of tax. Now, obviously you need financial advice. You need to get special advice for your situation. This is just general in nature, but that's a strategy that we've used multiple times to help us build a portfolio and to use leverage to our advantage. Now, on the flip side, if you are having to sell a property each time, then that is going to, one, take a lot of time. That's going to add a lot of stress. What sale price am I going to get? Got to deal with agents, got to present the property for sale, got to let tenants notice, all that sort of stuff. It's selling property is a stressful thing, and I don't know. In our opinion, if you can hold, it's always highly valuable. Now, if your plan is to hold, you do need to structure it with cash flow as well, because if you don't have the cash flow to sustain the equity release that you're trying to get from each purchase, then you will hit a servicing ceiling and you're not going to be able to continue moving forward. So you have to combine it with your capital uplift, but you also need to combine it with the cash flow to meet that capital uplift. And there's multiple strategies we can use, and a duplex is just one of them. You are essentially, when you're building a duplex, you're creating two dwellings, and we are therefore creating also two rental incomes. So we are getting a larger yield than just purchasing a standard property, which is obviously highly advantageous. Now, in some instances, sure, you're not going to be able to hold both sides, but in some instances you will. But if you build a duplex or you develop a duplex like this, you are going to have options at the back end of whether you hold both. And if you're holding both, probably don't need to strata title unless you need equity. Secondly, you can strata title them and you can sell one off and you can keep one. Or thirdly, you can sell both off and you can obviously take the profits. But then again, as I said, you need to pay tax on that, pay agent's fees. So our preference is to generally hold where we can. Sometimes we need to strata title to really lift that equity, but not always. Now, you might be asking, well, why do you see more value when you strata title? The reason for that is if you build a duplex or you develop a duplex, and let's just say, you know, it's $1 million. Let's just say it's cost you $1 million. The amount of people in the market for $1 million property is less than if you strata titled and now they're, let's say each one's now worth $600,000, because there is a hell of a lot more people in the market for a $600,000 property compared to $1 million property. So it significantly boosts the overall value of each property, because there's more people in that segment of in that market. So it's highly advantageous that if you're trying to extract as much value as you can, you do strata title, and you will reap the rewards. So, what else have I got to tell about this? I might just flip you guys around quickly. I'll just show you what's going on. I'm not going to go into too much detail around it, but I'll quickly show you what's going on, give you a quick tour of the site, and then we might save the rest for episode 2. So, flip you around. You can see here, we have a site on a corner lot. Now, we actually picked this site up, the whole site. Had one old house sitting on there, and we have actually subdivided this into 2. So we have one block here, and we also have a second block here. We've added all this footpath, we've added all the stormwater, all the sewer, all our water connections and all that. We've now created 2 lots. So we did this with a JV partner. They're actually holding on to this block here, and Bianca and I are actually holding on to that block there where you can see the slab. So I won't talk too much about the subdivision just at the moment. I might save that for the next episode, and I might actually talk about how we came across this site, what we needed to look out for, and I might go into a bit more detail around those sorts of things, the due diligence and everything associated with acquiring the site. So you can see here we've just got a slab down. We have our car parks, you can just see in the center there. We've actually got 4 car parks, so 2 aside, so 2 just in there. We've got another one just off to the side here, and we have another one just off to the side here. But you can see there, slab image of each other. And I'll talk about the design and all that in another episode, guys. But we actually didn't need council approval to build these 2 duplexes. I'm going to talk about how we did it in the next episode. So guys, stay tuned. If you haven't already, subscribe, get notified for when the next episode is live, because you don't want to miss out on it, because I'm going to talk about how to eliminate having to go to council to build a duplex just like this. Stay tuned.